All right, hello everybody. Todd Mitchell here. I want to welcome each and every one of you that took your valuable time out of your day to join me today. Again, I want to thank you for that, and I want to welcome you to what I'm calling the Big Profits from Swing Trading Stocks and Options class. Now, I saw a ton of familiar emails, a bunch of familiar names here that have been a subscriber or a student of mine for years, and I want to welcome all of you. Look at Scott from New Zealand is here. We've got Terry, Jerry, Rebecca from Australia. Boy, lots of people overseas, Europe. Got a lot of people here today. And again, a lot of you have been longtime subscribers of mine, and I really do appreciate it. We've got about 1,000 people online right now. And I know your time is valuable, so I'm only going to discuss actionable trading topics and strategies that can be applied to stocks, ETFs, and options. And in reality, you can apply the majority of what I'm going to show you today, all the concepts and strategies. You could apply this stuff to all markets. So if you trade commodities, forex, futures, currencies, doesn't matter what you trade. Again, the great majority of what I'm going to teach you today can be used without any change whatsoever. All right, now before I get too deep in today's class, I want to tell you about the topics that I'm going to cover during the next hour or so. Okay, now I've been getting tons of emails and calls from traders just like you, and a lot of you are actually here today. So again, I've been getting a lot of feedback, calls, questions over the past few months asking me questions about these specific topics that I'm going to cover. So I thought I would put together an intensive training session and cover them all during this time. Now first, I'm going to talk about the difference between trading pullbacks in comparison to breakouts and how pullbacks can help you significantly increase your profits and minimize your risk per trade. Next, I'm planning on exposing how 40 years of statistical backtests pinpoints the precise moving average time frame to utilize for longer term trend identification. In addition to short-term price swings, okay? Now this can drastically improve your trade accuracy, lower your risk per trade, and increase your profits significantly over time. Therefore, I want to spend some time on this topic because knowing this information can dramatically and drastically improve your market timing with very, very little work. So it's something that you really need to know about. I'm also going to show you a free financial website that you can visit, and with just a few clicks, identify stocks that are outperforming all other stocks using 9 months, 6 months, and 3 months relative strength analysis. I've had tons of requests for this information. I'm going to give it all to you during this 1-hour actionable swing trading class, okay? And next, I'm going to talk about options because options and pullbacks go together. Since implied volatility or expected volatility is lower during pullbacks in comparison to breakouts, and because so many of my students trade options, so I'm going to answer some important questions and demonstrate how buying limited risk call and put options can help you leverage gains and give you the opportunity to control the biggest, fastest gaining stocks and ETFs for a fraction of their cost, while giving you more profit potential than trading the underlying asset. And finally, before I conclude here today, I'm going to share with you the step-by-step rules to one of the most effective pullback strategies that you can integrate into your trading toolbox right away. You see, this is the exact same strategy that I've applied to stocks, options, futures, and currencies over the last 2 decades. And I'm going to give you the step-by-step rules during this 1-hour intense training session. All right, so as you can see, I've got tons of actionable stocks and options trading material to share with you today. But before we begin, I want to go through the required government disclaimer, and I will leave it on the screen for you and highlight some of the most important parts, because this disclaimer makes a whole lot of sense. First, you should only trade with risk capital, which means don't trade with money that you've put away for your kids' college or your retirement. Trading is speculative. That means you have to start out paper trading or start with a small account until you become familiar with the strategy and increase your trade size gradually. Second, if you use leverage, you not only increase your profit potential, but you also increase your risk of loss. So if you use margin or sell naked options, which I don't recommend you do, you are effectively increasing your risk beyond your capital, and that's something I do not recommend you do till you become consistently profitable over time. And third, losses are part of trading and will occur no matter how long you've been trading or investing. You can't avoid them. So please do not add to losing positions and do not average down your losing trades. Okay, now that we've got the housekeeping out of the way, I want to tell you a little bit about myself. And I promise you that I will keep it as short as possible since I have so much to cover during today's class. Okay, I live in Birmingham, Michigan with my beautiful wife, Karen, and my two unbelievable kids, Olivia and Christian. And I was originally introduced to the financial markets in the 80s by my father while I was still in high school, and I've been trading since 1988. I can't believe it's been over 29 years now. Now, after graduating college, I started trading concepts in 1994, and over the past 23 years, I've taught thousands of traders all over the world how to generate consistent profits from the markets through my comprehensive mentoring programs. I've also advised a handful of traders who went on to manage big money on Wall Street and started their own multi-million and multi-billion-dollar hedge funds. So you can say I've been around the block a few times, and more importantly, I know what works and what doesn't. For several years before the internet revolutionized how we live our lives, I held private trading sessions and have a passion for trading financial markets and teaching traders how to apply low-risk trading tactics to different types of market conditions. Lastly, before I begin, and if you have any questions, please don't hesitate to write them in the box below the video screen, and I will be more than happy to answer each and every one of your questions before the end of the day. I have my assistant handing me the most relevant questions so I can answer them live. And if your question doesn't get answered live, don't get discouraged. We have hundreds of questions coming in, and I simply don't have the time to answer them all live for you. But I promise that before the end of the day, you will receive a response from me, so please check our inbox later today, okay? All right, the first and very important topic that I want to start off with is the primary difference in terms of profitability between trading momentum or breakout style strategies and pullbacks. And before I get into the issue, I recognize that some of you are just starting out, so let me explain to you what breakout or momentum style trading is all about before I get ahead of myself, okay? Breakouts or momentum style trades occur when price is moving higher quickly and breaking through a specific resistance level to the upside, assuming you are trading long. And of course, if you're trading short, then a breakdown in price would occur when price trades below a specified support level to the downside. Now in this example, you can see ticker symbol CAG breakout. And as you can see, the stock continues trading higher for several days. The breakout is one of the most popular trading styles and has numerous advantages, including quick price movement because you are buying when price has already started moving, and bigger price gains since volatility is usually higher during periods when stocks are breaking out of their trading range. All right, the downside of breakouts is the fact that roughly 70% of breakouts are false, and that means the stock moves higher just enough to trigger a price high and then reverses and trades lower back inside the trading range. In this example, you can see a false breakout. Every time the stock trades above the 50-day price high, price reverses and falls back in line with the trading range, and that's the biggest downside of breakouts, the increasing number of false breakouts. And we have a question from Brian from Colorado, and Brian's asking why over the years stocks tend to have more and more false breakouts. And Brian, that's a fantastic question and right on point. The reason why stocks are experiencing more false breakouts is because over the years, the markets are being controlled by hedge funds, mutual funds, and institutional traders who initiate computerized buy and sell programs. And when these funds buy over a period of several days, they cause price to inflate. And then when they stop buying, it dries up the buying pressure quickly and causes price to reverse. In the old days, when retail traders control the markets, price would move slowly up or down over a period of several weeks. We call those periods long-term trends. But over the past 20 years, large financial institutions and banks control the stock market. And they don't buy thousands of shares at a time. They buy hundreds of thousands of shares of different stocks with the push of a button. And that causes a rise in momentum in the short term. All right? And I hope I was able to answer your question, Brian. And I really do appreciate you participating in today's class. All right. Now that I've explained the basic principles of trading breakouts, I want to go over the pullback, which is simply a price retracement after a breakout occurs against the direction of the main trend. One of the major advantages of pullback entry is the fact that you are entering the trade after the asset has had chance to trade lower, after the breakout already occurred. So you are effectively entering after the big rush of buying already occurred, and the buyers who purchased during the initial rally are worried about price moving lower. Pullbacks offer lower volatility levels in comparison to breakouts, and therefore the risk associated with trading pullbacks, such as the stop loss level, could be closer to the price of the actual asset as a result. Lower volatility decreases risk per trade, while your profit potential is the same as when you were trading breakouts. The percentage of profitable trades when utilizing pullbacks can be as high as 70% because there's less volatility, panic, and lower random trading noise that's commonly associated with breakouts. And that's what makes pullbacks increasingly desirable for traders of all experience levels. Now, to identify a classic pullback, you need to precisely target the exact location of where the long-term trend and the short-term trend begin, moving in the same direction. The reason why identifying this price point or level is crucial is because it creates an ideal low-risk entry opportunity that can work very well with any tradable asset. Now, in this example, you can see the ticker NVDA. I identified the long-term trend as well as the short-term trend using simple visual analysis. The distance between the entry and the stop loss price level or your risk level is minimal in comparison to breakouts, where you are buying near price highs instead of buying an asset after the asset has had a chance to pull back against the trend and once again begins moving higher once again. And because your risk is lower, your profit per trade doesn't have to be as high with pullbacks, and that means you're holding positions less time when trading pullbacks instead of breakouts. So in addition to less risk, higher profit potential, and higher percentage of winning trades, pullback entries have significantly lower holding periods than trades initiated with classic breakouts. We have a question from Howard who's asking, if pullbacks are so much better, then how come traders continue to use breakouts? And Howard, that's an excellent question, okay? The reason why traders continue to trade breakouts is because the higher volatility associated with breakouts can produce bigger profits. And some traders don't mind the bigger and more frequent losses because the bigger gains can and do overcome the losses, right, in the losing trades over time, over the long run. And some traders have methods that rely on catching that one big price move, and they don't mind having 5 or even 7 losers or small winners before catching that home run trade. Now, while others like myself prefer more stability and consistency in their trading, and when you're swing trading, you don't have time to recover from large losses, which can occur with breakouts. See, you're trading for consistent gains, and that lends itself better to pullbacks. Since there's less inherent risk, okay, So I hope I was able to answer your question, Howard, and thanks again for participating today. Okay, so now that we understand the basics of breakouts and pullbacks, we need an efficient method of identifying pullbacks using simple moving average indicators. And over the years, one time period that I keep coming back to is the 50-day moving average indicator, and this can be found on just about every technical analysis software program or your broker's order entry platform system that you can use to place your trades. Now, the reason why the 50-day moving average is so effective is because the great majority of institutional traders use the 50-day moving average as a barometer to determine if the stock has a bullish trend or a bearish trend. Now, institutional traders do not like to accumulate large quantities of shares if the overall trend is lower, and the 50-day line gives a very quick indication of whether or not the stocks are trending higher or lower. It's that simple. Now, over the past 20 years, markets have become dominated by institutional traders. And when you have so many different institutional traders using the same indicator to gauge accumulation and distribution, the indicator continues to work because there's so much market share using it to gauge key price levels. All right, now in this example, you can see the exact same stock that I demonstrated a few minutes ago, NVDA. But this time we have the 50-day moving average instead of a visual trend like I showed you in the recent example. Notice that price tends to stay above the 50-day line for the great majority of time, and each time there's small corrective pressure. The stock quickly bounces back as soon as it hits the 50-day line and moves higher once again. And Frank from Hawaii says, "This is a great class, Todd." And Frank, I appreciate your feedback, and it's great to have you here today. All right, take a look at this short example. The ticker TSLA, it's Tesla, right? Notice how each time the stock price trades lower, it tends to come back up to the 50-day moving average and then reverts back lower in line with this main downtrend. As a matter of fact, during this 4-month time period, the price of the stock cannot remain above the 50-day moving average more than a day at the most. And I have another question from David who's asking if I've tested any other moving average indicator. And thanks, David, for participating. And yes, I've tested just about every length of moving averages over the last 3 decades of my career. And there's many, many different ways to use these indicators. But the most important, okay, is not the length of the indicator, but knowing which time frames work effectively with different trading methodologies, right? If you're trading breakouts, you don't want to use a 20-day moving average. That might have worked well with commodities 40 years ago, but that will not work with stocks today. While 50 and 90-day moving average indicators work fairly well. So it's a matter of knowing which moving average time frame works best with your specific methodology. And that's the crux of all this. You see, it's like a screwdriver. It's not one size fits all. One size works great for one size, but it's completely ineffective for another size. And the moving average indicator works exactly the same way. So you first have to determine what you're trying to accomplish and then select the time period for the moving average. Now, many traders assume that the 20-day moving average or the 90-day moving average works well for every type of analysis and time frame. And that's just not true. So keep that in mind when using moving averages and strategies that are created with a combination of moving averages and price or dual moving average indicators working together. Okay? Once again, thanks for participating, David, and have a fantastic day. All right. So to summarize exactly what you need to get out of the last 2 examples is the fact that the long-term trend is identified by the 50-day moving average and the short-term trend is identified by movements that bounce towards and away from the main trend. If we are trading to the long side, for example, the long-term trend remains intact as long as price remains above the 50-day line. And the point where the short-term trend and the long-term trend intersect occurs at the point where price moves to or below the 50-day line and then begins to consistently trade above it. And the reason why this creates the lowest risk entry opportunity is because you know almost immediately if the trade is working out or not. And that's because if price action moves below the 50-day line, then you know that price is violating the main trend, and that violates the entire premise behind entering this trade in the first place. And if you're trading to the short side, once again, the trend is identified by the price action trading below the 50-day line to the downside, and the short-term trend is identified by price action that's moving towards and away from the main trend. Now, the lowest risk entry opportunity occurs at the point in time when price action trades at or below the 50-day moving average in the direction of the main trend. Now, you always want to trade in the direction of the main trend, and in this case, you would trade to the short side, and if price violates the 50-day moving average to the upside, then the trade would be immediately liquidated. And keep in mind that there's numerous ways of identifying the long-term trend and the short-term trend, right? And I simply wanted to give you a very simple framework to use and apply to your own trading immediately. And now we have a great question from Charles from Atlanta. And Charles is asking why we're relying on the moving average indicator for entry since it's a lagging indicator. Okay, now Charles, that's a good question, but let me answer your question, okay? Look, we're not relying on the moving average indicator for entry and exit. We're relying on price action. And for those of you that know me, you know that I believe that price action is king, okay? Which is the most leading indicator available, right? Price action. You've heard me talk about this a gazillion times. So we're using the moving average as a gauge of the current market rhythm. But we are actually relying on price action completely since we are using price to dictate our entry as well as our exit. And I'm glad I was able to clarify this for you, Charles. And again, thanks for participating in today's swing trading class. Now, I'm also going to teach you a simple free method of identifying stocks that are outperforming all other stocks using 9 months, 6 months, and 3 months relative strength analysis, which is just a fancy way of identifying stocks that are increasing in terms of percentage gain the most in different time periods. And before I explain and go over the process with you, I want to explain why this information is so important and how it fits into the overall topic of trading pullbacks and the moving average tactics that I just explained a few minutes ago. Now, when I showed you the examples of using the combination of the 50-day moving average and price to determine pullbacks, now in essence, you have to first identify or find the stocks or ETFs that are moving strongly or directionally. And in my over 2 decades, almost 30 years of trading experience, very few methods can match relative strength for targeting stocks that are outperforming all other stocks. So, to give you some perspective, when using traditional technical analysis, you are basically looking at price of one asset. But when you're using relative strength, you are comparing one stock against another stock, which is much more important than looking at one stock in isolation. Let's say you're in a super bullish market cycle. Well, according to statistics, most large caps have a correlation of about 66%, which means if the overall market is moving sharply higher, most stocks will move higher, and it works the same way to the downside when we have a correction. Now, I'm sure most of you have seen the Dow correct several hundred points over a period of a week or even a day, right? And I'm sure you've all seen that most stocks are impacted by that. So, if we apply technical analysis during a bullish market cycle, most stocks will trend strongly. So, it's really hard to determine which stock is truly leading the market higher. Now, if you doubt what I'm saying is true, just take a look at a period of time when the stock market was trending strongly higher for 2 to 3 months, and you're going to see that most large cap stocks are moving sharply higher. So unless the market is congesting and trading sideways, it's very hard to truly spot the big gainer or that one stock that's outperforming several others. And why is this so important, you might ask, okay? Because large institutional traders and hedge funds accumulate the strongest stocks as they continue gaining strength at the expense of weaker stocks that are not rising as quickly. It's very similar to the theory of survival of the fittest. The stronger the stock, the more institutional buyers will continue to drive price higher by continuing to buy that stock. And these are the stocks that you want to be in. The ones that the biggest funds are buying, you want to wait for them to correct. But you need to first identify them, and relative strength analysis gives you the ability to do just like a large hedge fund. And I'm going to show you exactly how it's done at no cost right here and now. Now just head over to barchart.com and click on the Stocks tab right below the main logo. And then just scroll down just a bit and you will see two vertical tabs along the left and the right side. The first one is the percent advancers, and you will see several time frames there. And right below that you will see percent decliners, and you will see the stocks that lost the most value over a specified time period. Now I typically rely on three different time frames: the 3-month time frame, the 6-month time frame, and the 9-month time frame. If I'm swing trading and looking for a very short-term price move, then I would focus on the 3-month time frame, and what I'm covering applies to both long and short positions equally. Okay, so keep that in mind. So to continue, if I'm looking to hold positions for about a week to 2 weeks, then I would more than likely focus on the 6-month time frame. And if I'm considering holding positions for a longer period of time, then I would consider the 9-month time percentage change. And oftentimes you will find the same stocks on all three time frames. And that's going to tell me that the stock is currently being accumulated consistently over the entire period of time. And those are your best stock picks. Now, this is how you would identify and select the stocks you would apply to pullback analysis methods that I started this whole workshop with today, okay? But over the past several years, I found that a lot of my students over the years have struggled with finding the right candidates. While institutional traders have access to tools that generate a list of stocks that match relative strength criteria, with a bit of work, we can create our own list by simply following a few simple rules and guidelines. And I want you to know that everything I'm teaching you today, I picked up over the years by following numerous institutional traders who use the exact same methodology for targeting the stocks that they select day in and day out. And this is an example of stocks that are making the highest percentage gains over the past 6 months. I usually begin by clicking on the percent change tab to organize the stocks with the biggest percent change to show up at the top. And what I would do is only select stocks from this list that fit a specific criteria, and this will eliminate a very large portion of stocks from the list. So what you want to do is eliminate all stocks that are priced under $25 per share. Stocks that trade less than 500,000 shares per day average volume and have a daily trading range greater than $1.50 per day. Otherwise, the volatility will be on the small end of the range. This will eliminate a large portion of small caps and stocks that are moving higher because they lack liquidity. Now, we don't want to trade these stocks. They are too speculative and can cause uncertainty, and that's something we want to definitely avoid. And we have a good question from Michael from Orlando, and Michael is asking why we eliminate stocks that are priced under $25. And the reason we're doing this, Michael, is because we are targeting stocks that are being purchased by large institutional traders and hedge funds, and they usually stick with larger stocks that have large market cap and have strong institutional sponsorship. Now, those stocks are typically priced at over $25. And these stocks are the ones that can really move a lot in a short period of time. And that's what we want when we are swing trading. So I specifically focus on stocks that fit this criteria because they are targeted by large institutional traders who can really move the price of the stock tremendously over a short period of time. All right? And I hope I answered your question, Michael, and thanks again for participating today. Now, while the filtering based on higher price, volume, and volatility will eliminate a large percentage of small cap stocks or stocks that move as a result of illiquidity, we also want to focus on stocks that are gaining strength evenly as the price continues to rise. And if we're trading to the short side, we want to see price move down gradually. If we see parabolic movement where volatility increases substantially, the odds are strong that the trend will end shortly. But when the price action gradually increases, it gives a good probability that price will continue to move directionally. So don't make the mistake of just looking at the hard numbers without taking price action into account. And most rookie traders don't focus on volatility comparison, which is one of the biggest factors that will determine whether the trend will continue or not. So what I will do is show you a few charts so you can see for yourself the type of trading action that I'm looking for, both to the long side and to the short side, and what type of price action we want to avoid. Now, in this example of NVDA, notice how the trend continues moving evenly without a major rise in volatility. When volatility and trading range continue over a period of time without increasing too much, it's a very powerful indication that the overall trend will in fact continue to move directionally. Now, when the trend increases too quickly, it means there is a very strong imbalance between buyers and sellers, and that catches up with the overall trend and causes the market to stagnate or correct. But when the trend continues at a reasonable rate without too much parabolic movement in either direction, it means that buyers are outpacing sellers by a small margin over time. This type of activity can go on and on for a long, long time because there's no real psychological imbalance between buyers and sellers. Now take a look at this example of Amazon. You'll notice that price starts out trending at a reasonable angle and after a short period of time explodes higher. This type of price action rarely sustains itself over time unless there's solid data behind the price move that's not based on speculation. But those price moves are almost instantly priced in or assimilated into the price of the stock. So the majority of volatility that you see during the trading session is based on speculation and more often than not terminates after a few weeks. Once again, many traders who are starting out believe that when volatility increases, the odds of making more money increases. But in truth, your risk increases substantially more and price action becomes highly unforeseeable. And volatility is actually one factor in all of my trading strategies. And we have a question from Ken from Florida. And Ken's asking how we apply relative strength and volatility to pullbacks to increase our odds of success. And Ken, I know there's a lot to process and I'm trying to fit a lot of info into a short amount of time right now. So I'm going to summarize the most important parts before moving ahead so it makes more sense to all of you. All right? Let's do it. Now the first thing you would do is to identify stocks that are making 9-month percentage gains, 6-month percent gains, and 3-month percent gains. And you would put more weight on the time frame depending on how long you intend to hold a position. If you're holding positions for a day or two, there's no need to look beyond 3 months. And if you're holding positions for a week or two, then the 3-month and 6-month time frame would be beneficial. If you are in fact holding positions for more than 2 weeks, then it's best to focus on longer term 9-month time periods as well. Now, the ideal scenario is to find stocks or ETFs that are making big gains across all 3 time periods. Once you screen out all stocks based on price of $25 or higher, stocks that have lower daily average volume of 500,000 shares per day, and average daily ranges of over $1.50, then I would look at the charts visually to determine whether or not the stock's trend is moving steadily over a period of time or instead choppy with parabolic periods or simply substantial increase in volatility over a short period of time. Now in these scenarios, the odds of the trend ending are strong, and the best path to take is to avoid trading these stocks altogether, okay? Or you can just use them as a basis for pullbacks, which is the point of all of this. And lastly, you would avoid using this analysis for your entry. This is limited to identifying the stocks that you intend to put on your hit list, okay? The ones that are moving in line with the long-term trend. The short-term trend would be identified by either price, as I demonstrated earlier, or by another method that I will demonstrate before I finish today's class. So don't forget, we don't use this analysis to determine when to enter. We use this analysis to determine what stocks or ETFs we want to target. Now, this defines the long-term trend, either up or down, but it's not the tool we use for entry. I want to be clear on that point before I move ahead. It's real important. And Dana from Rhode Island says that she's getting tons of real value from this training, just like I promised. Thank you, Dana. I appreciate the feedback, and as I promised earlier, before I conclude, I'm going to go over the step-by-step rules to one of my favorite swing trading strategies that you can apply to the markets right away. And it will help you identify the pullback the right way. So make sure you stick around to the very end, okay? So the next topic that I want to cover is how to select the best call or put option for trading pullbacks. And I know many of you struggle with options or find them intimidating. But the key to options is to keep things as simple as possible. And I've received tons of questions about swing trading options. But the great majority of the questions are centered around three simple principles, and that's what I'm going to focus on today, okay? So the first issue is understanding how volatility impacts the price of the option. And I'm going to explain this in very, very simple terms, okay? Now, the second issue is how much time value or time premium you need to buy. And the third issue is how far out of the money you should go to maximize your profit potential. There's a lot to discuss, so let's jump right into option volatility because it's a huge part of the options premium. And in essence, it's like the pink elephant in the room, and we have to address it before we move ahead. Okay? The value of the option is largely dependent on the expected volatility of the underlying asset. Now, if the stock moves $3 per day on average, the options value will be more than if the stocks had average daily volume of $1.50 per day, right? Because if the stock moves $3 per day, then the odds of it moving quicker to a higher or lower price level is much greater. And at least statistically, than if the average daily range is only $1.50. So assuming everything is identical between the two stocks, the disparity in the price of the option can be as high as 50 to 100%. Now, just because of the volatility, so it's something we have to pay close attention to, since it can greatly influence the value of the option. Now, if you recall, when I first started today's class, I explained that most trade setups are divided into breakouts and pullbacks. And when stocks are breaking out either higher or lower, 9 out of 10 times volatility levels increase tremendously, and that causes options prices to explode. At least the volatility portion of the options price, which makes up a huge chunk or a huge portion of the total cost of the option. I've seen options that were trading for a $1 increase in value to $2 and even more after a breakout occurs, and when the breakout continues, the option barely gains any more value, since the volatility increased so much right after the initial breakout that the options price already assimilated the price moving higher ahead of time. That's called implied or expected volatility, and that's what drives the price of the option. Okay? I've told stories many times before that when the market crashed in October in the late 1980s, right, 1987, even when the stock market stopped trading lower, the put options continued to increase in value because traders anticipated more downside, right? Now, that expectation that options traders have is another way or describing implied volatility. All right, now the good news is the fact that pullbacks usually cause stocks to lose volatility or decrease in volatility. Now, I've backtested thousands of breakouts and pullbacks, and the average breakout increases volatility or the trading range by about 50% on average. Because by definition, a breakout is a new higher low in price, and that's a major psychological shift for traders who believe the momentum is never going to stop and continue accumulating till the price no longer moves higher. On the other hand, the average pullback decreases volatility about 30% on average. So pullbacks cause the price of the option to naturally decline, since there's less panic and emotions associated with pullbacks in comparison to breakouts. Now keep in mind, the pullback occurs after the breakout, after all traders who bought as the price continued moving higher already finished buying and are sitting tight and waiting for price to continue moving higher. And while the stock is pulling back, most of the traders who purchased just a short while back continue to maintain their position. So there's much less activity against the momentum movement, and that means volatility is naturally lower, and that's extremely beneficial for premium or options buyers. And Kenny from Austin has a question. Kenny, welcome to today's class, and Kenny is asking if implied volatility is high during earnings, regardless if the stock is pulling back or breaking out. And Kenny, that's actually a really good question, and I want to answer it for you right now. Now, whether the options prior to earnings have high implied volatility has everything to do with one factor and one factor only, and that's the expected earnings based on historic earnings and expectations. If the expectations are fairly low, then the options will have low implied volatility, since traders are not expecting a big move, right? But on the other hand, if the company is subject to controversy or a hot growth stock that's always surprising investors like Apple or Google, for example, then you will see high implied volatility. Now remember, Kenny, implied volatility and expected volatility are one and the same. All you have to do is put yourself in the shoes of the options buyer and ask yourself whether or not you expect, based on everything that's known about the stock at that moment in time, if it gives high probability of huge price movement. Now, if the answer is yes, then the expected or implied volatility will be high. Now, if the answer is no, then implied volatility will be on the lower end of the range. If, for example, the stock is a takeover candidate, then regardless of the price action, implied volatility will be high and the options will be extremely overpriced. Now, if on the other hand, the stock has not moved over 2 points over the last 10 earnings sessions, right, the odds are high that implied volatility will be low regardless of whether it's earnings season or not. Okay? Again, whether it's earnings season or not. I hope I was able to answer your question, Kenny, and thanks for participating in today's training. All right, so now that you understand the basics of implied volatility and volatility responds to both pullbacks and breakouts, I want to answer the important question of how to select the right strike price. And this is a very important, okay? Again, this is very important to get right, and I see lots of traders making very similar mistakes. What usually happens is the stock makes a reasonable size price move and the option barely moves and the trader is left wondering what went wrong. It's as simple as that. And the biggest reason why this occurs is because the trader did not take into account the delta of the option when deciding which option to purchase. Okay, the delta of the option dictates exactly how much the option will fluctuate for every $1 move in the price of the stock. While the delta is a moving target and will change, it will give you a very accurate idea of what to expect, at least initially from the option that you're targeting. For options that are out of the money, which means the strike price is a bit distant from the price of the underlying asset, the delta can be as little as 20 or 10 cents. Now that means for every dollar the price of the stock moves, the option will only fluctuate 10 cents. On the other hand, if you buy an option that's an at or in the money, which means the strike price of the option and the price of the underlying asset are close to each other, the delta can be as high as 70 or even 80 cents, which ultimately means that the option will fluctuate about 70 to 80 cents for every $1 change in the price of the underlying asset. All right, now what you need to take into consideration is the type of price move you're anticipating in light of the delta of the option. If, for example, you believe the stock will move $5 over the next few days, then buying a far out of the money option for 50 cents may not be a bad idea. Even if the stock has a delta of 10 cents, the price of the option will at least double, so your return on investment at least 100%. On the other hand, if you're buying an option for $10 and the option gains the same 50 cents, then the option only gained 5% in value. So always take into consideration the value of the option, the delta of the option, and the expected price movement. Because without those three factors, it's impossible to decide whether or not the option is too far out of the money or too close. Okay? But once you plug in these three factors, the value of the option, the delta of the option, and the expected price move, then you can gain a real assessment of whether the option is a good fit under the current circumstances. Now, John from New Mexico says that he's getting more out of this class than most paid webinars he's attended in the past. All right, thanks, John. I do appreciate it. And make sure you stay to the end of the training, because after I'm finished with options, I'm going to jump into a short-term swing trading pullback strategy that works with any type of market. And I'm going to give you all the rules and show you a few setups before I finish up today, okay? And we have a question from Carl from Washington. And Carl is asking if buying in the money options ever makes sense. That's actually a great question, Carl. To answer your question, when options have a high level of implied volatility, going deeper in the money can alleviate some of the inflated premium that you pay. Now, the reason that's the case is because there's much more speculation in out-of-the-money options that are made up of pure time premium. And options that are deep in the money are mostly made up of intrinsic value instead of time value. That's why they are in the money, okay? So if implied volatility is on the higher end of the range, then getting in the money makes sense. But in my experience, a high level of implied volatility is typically associated with stocks that are on the move or are breaking out instead of pulling back against the trend. Now, typically, you see volatility contract when stocks are pulling back or congesting, right? Like I spoke about earlier, since there's barely any momentum going on during that time. So there's much less speculation going on between buyers and sellers during pullbacks. And because that's the case, implied volatility will be lower and option premium will be cheaper as a result, which is ultimately one of the biggest reasons why pullbacks are so attractive with option traders. Okay? And thanks again for participating, Carl. I do appreciate it. All right, so let's move on to the final topic relating to options, which is once again one of the most frequent questions that I see in my inbox. Now, in a nutshell, the question relates to how much time premium is appropriate for swing trading strategies. And this is a very important topic, especially since weekly options were released several years ago, okay? Before weekly options, the choice was simple. You either pick the next expiration or the following expiration. So it was always one of two choices. So the decision was rather simple. But now, with weekly options, we have options expiring every week. And that gives us the opportunity to fine-tune the amount of time premium needed. And we have a comment from Jerry from Montana. Jerry, thanks for participating today, and I really do appreciate it. And Jerry says, I always buy options with a 3 to 4 months of time premium and end up selling them instead of letting them expire. All right. And Jerry, that's not a bad idea, but the problem with buying options that have too much time premium is the fact that more often than not, they don't have too much liquidity. Since the majority of traders buy options that are only a few weeks or a month away. So when you buy options that have so much time till expiration, the options end up having a wide spread between the bid and the offer, sometimes as much as $1. So just getting in and out of these options will cost you money. So you may want to consider buying a bit less time the next time you target options instead of stocks. Again, thank you for participating. I really do appreciate your valuable time and spending it with me here today, okay? Here's what you need to know, and this is a fairly good estimate of decay. The majority of time, decay occurs during the last 3 to 4 weeks till options expiration, and more often than not, because I'm swing trading, I usually hold the position for less than 1 month. So what I typically do is purchase options with about 8 weeks of time premium till expiration. I find that by the time the option has 4 weeks till expiration, the intended move already occurred and the option is liquidated. Or alternatively, the trade did not work out as planned and the option was liquidated with a loss. But in either case, see, I rarely end up holding an option trade longer than 4 weeks, and I find that the level of decay is usually not significant enough to reduce the gain below acceptable profit levels, or in turn, a loss too far beyond the worst case scenario. All right? As a matter of fact, and this is something you should really pay attention to, is the fact that options with about 3 to 5 weeks till expiration, which is the time we end up liquidating the option, happens to be the most liquid period of time for options. And the liquidity levels tighten the spread between the bid and the offer. And this gives you an opportunity to offset some of the loss that you incurred due to holding the option for 3 to 4 weeks. So in a nutshell, if you're swing trading, you really can't go wrong buying an option that has roughly 8 weeks till expiration. It'll give you just enough time value to participate in a reasonable sized price move and at the same time not lose so much value that the price gain in the underlying asset is offset by the loss to the value of the option due to time decay. And we have a question from Sam from Arkansas. And Sam is asking, what if you are only intending to hold the position for 2 to 3 days? Sam, if you have a concrete or specific time period that you will be in the trade, then you can take advantage and fine-tune the amount of time premium specifically to the trading plan that you have in place. But the great majority of the time, traders do not have a specified entry and exit time frame. So we have to estimate when the price move will occur, and that's why we want to buy about 2 months, since the odds that a price move will occur during the first month, especially if you are trading high probability swing trading setups on fast moving stocks. All right? And I hope I was able to answer your question, Sam, and thanks again for participating. And now I want to show you a simple pullback strategy that I've applied to various stocks, ETFs, and options over the past 2 decades. And it still holds up just as well as it did when I first began using it in the late 1990s. Now, the reason why I decided to demonstrate this specific strategy is because it will make the process of identifying the long-term trend and the short-term trend very simple and easy for traders who are intimidated by all of this, okay? Now, I recognize that many of you are just starting out, and this strategy will take much of the guesswork out of the equation for you. Now, I'm going to go through the strategy, give you the rules, and then show you a few examples so that you understand the dynamics behind the 110 strategy today, which is the name of the strategy that I'm going to demonstrate for you right now. All right, the rules are very simple, and I'll go over them with you right now. And I highly advise you to select your hit list using the 6 and 9 month relative strength levels, since you want only the strongest stocks if you are trading the strategy to the long side, or of course the weakest stocks if you want to trade to the short side. Once you select the strongest stocks using the 6 and 9 month relative strength analysis, you would wait for the price of the stock to trade up to the 100-day price high and then make a 10 trading day price low within the next 15 trading days. Now, my research shows that stocks that have strong relative strength and are making 100 trading day price highs are more than likely to continue moving higher. But more often than not, the same stocks pause for a short period before continuing the trend. I've noticed this countless times throughout the years, and I'm very confident that this price pattern will continue for many, many years moving forward. Now let's take a look at the following example of NVDA. Now in this example, you can see how the stock makes a 100-day price high, and that's how we define the long-term trend. And that satisfies our first requirement or condition. The next step is a pullback, one that takes price back down to the 10-day price low. That's the pullback against the long-term trend, and that gives us the perfect entry opportunity. If we are trading options, I can assure you implied volatility is substantially lower after price stagnated over the past several trading sessions, since price is moving against the long-term trend. Now, once we identify the 10-day price low, the third condition and our entry point occurs if the stock trades above the highest price high by about 5 cents the day after price makes a 10-day price low. And you can see the whole progression in the current NVDA example. If you're filled on the trade, your stop loss is placed right below the point where price made the 10-day low, since taking that price out would mean that the stock is not reverting back to the long-term uptrend, and that's not the position we want to be in. The profit target on this trade is the distance between our entry and the stop loss, multiplied twice and added to our entry. You can see the stop loss and the profit target in the current example, and because the stock has such strong momentum behind it, it takes only a few trading sessions for price to begin moving higher, and in less than 10 trading sessions, we take profit on this trade. Now, if you're trading options instead of the underlying stock or ETF, you would instead never ever use a stop loss order and instead use a mental stop loss. Now, what this really means is you would enter the option and exit the option at the same time you would enter and exit the actual stock. So you end up using the underlying asset as a proxy, but instead make actual decisions using the options contract. Now I'm going to walk you through another example so that you can get a solid feel for the 110 strategy. This is ticker symbol CBOE, which is the Chicago Board of Options Exchange. And during the summer of 2016, the stock was increasing in relative strength, much more than the great majority of stocks on Wall Street. And it made its way on our hit list. The stock makes a 100-day price high, and over the next 2 weeks following the 100-day price high, makes a 10-day price low. Now keep in mind, without these two conditions satisfied, the setup cannot be formed. In other words, you won't know if the 100-day high has significance unless over the next 2 weeks following the day that price made the 100-day high, we also see a 10-day price low. So we have to have both conditions satisfied before the 110 setup is correctly formed. Now, once the setup is formed, as we see in this example, we want to see price break above the 10-day price high the following trading day. We typically place a buy stop about 5 cents above the price high of the day the stock traded at the 10-day price low, and the stop loss is placed a few cents below the 10-day price low. That way, if the 10-day price low is taken out, the stock is not ready to revert back to the main uptrend, and it's best to exit the position instead of waiting for the trend to resume at the same point in the future. Now, the profit target is the distance between your entry and your stop loss multiplied twice, right? Now, notice that it doesn't take very long for the stock to bounce back and trade near 100-day highs once again. Now, that's the kind of stocks you tend to identify when you utilize the combination of 100-day price highs, 6-month and 9-month relative strength to identify the strongest stocks on Wall Street. All right, and I now have a question from Ken, who's asking if we can trade this strategy to the short side. And that's a great question, Ken. You would simply identify the weakest stocks over the last 6 to 9 months using relative strength analysis, and then find stocks that are trading at 100-day lows and are turning back higher over 2 weeks and rallying temporarily. Then you would enter on a sell stop the day after the stock trades at a 10-day price high if the stock turns around and takes out the low the very next day. So you would just reverse the rules. So you can trade the 110 strategy to the long side and to the short side. And Ken, I would like to thank you for participating in today's class. I actually want to thank everyone since the questions and the feedback that I've been seeing are absolutely terrific. And I want to thank you for the very kind words that I've received over the last 55 minutes or so. So thanks again, everybody. All right, let's move on. All right. And that actually brings me to something very important. While the concepts and the tactics that I covered in this workshop are very actionable and something you can apply to the markets right away, I've only scratched the surface with pullbacks and the overall trading methodology that targets pullbacks, okay? In practicality, there's much more to know, and that's why I created an extensive 3.5-hour video course titled Swing Trading Stocks and ETFs for Weekly Income. I want you to keep in mind that I've been trading close to 30 years now, and most everything I know about trading pullbacks is in this one course. It's very structured and puts everything into perspective for you. Now, I recognize that some of you are just starting out, and I can promise you that there's no better way to get up to speed without going through expensive and painful mistakes by reinventing the wheel. I mean, I did all the hard work for you, and I've made my share of mistakes over the years when I first started off and throughout the years, right? But over the years, I learned what really works, and that's what I share with you in this Swing Trading Stocks and ETFs for Weekly Income course. First, I'll show you my proprietary approach to trend identification. It's very simple, yet very powerful. And once you see how I dissect price action with a combination of simple technical indicators, I can promise you that you will never look at price charts the same way again. My simple 1, 2, 3 method is so precise that it will help you identify the trend in the pullback with ease every single time you look at a price chart. I'm going to show you my favorite low-risk, high-probability trade setups. And these are the same setups that I use in my own trading, day in, day out. They offer the highest potential for profit, and more importantly, consistently, over time. If you like the 110 setup, I can promise you that you will love the setups that I teach you in the Swing Trading Stocks and ETF through a Weekly Income course. You will know exactly when to enter each trade, where to place your protective stop loss, and I'm also going to show you exactly where to take profits on each trade. There's no ambiguity and everything is spelled out very clearly, and I provide numerous examples of actual trades. This way you will see exactly the entire process behind each trade, and there's no better way to learn than to go through actual trade examples, step by step, A to Z. And I do want to remind you that nothing in this training requires any special type of technical analysis software or program. You can find all the indicators that I show you inside your broker's online software or free online charts that have numerous indicators already provided. Now, I know many of you already use TradeStation or NinjaTrader, so I know a lot of you already have those. That's fine, but if you don't, no big problem, no big deal at all. You can use really anything on the market, okay? Next, I realize that many of you are just starting out with a very small account and want to build it up quickly, right? So I'm going to show you a few simple tricks that will help you increase your gains quickly. And you won't believe how it's possible with just a few simple tweaks. And I'll show you exactly how to do this. This will help you grow your small account and turn it into a much larger account as quickly as possible. And I know many of you are interested in applying swing trading principles to the options market, right? Options give you the ability to leverage your gains with limited risk. And I'm not only going to teach you the basics of options trading, but I'm also going to teach you how to select the best call and put options for swing trading, the setups that I'm going to teach you in my extensive swing trading course. You will learn about intrinsic value and time value and how time decay impacts the value of the option as well. So if you're targeting options instead of stocks, or if you have a small account and want to leverage the power of options and build it up quickly, This course will help you get started with options right away. All right, now one of the most frequently asked questions that I get from traders like you is, Todd, how do you select the right stock or ETF to trade? So I included my complete criteria for selecting just the right stocks and ETFs for swing trading pullbacks. This is the exact same criteria that I apply in my own trading. It took me many years to identify just the right combination of volume, volatility, and closing price, and I'm including it so that you can get up to speed real quickly without wasting your time picking the wrong stock or ETF. Of course, if you trade ETFs, you won't have to search any further because I included a list of top ETFs, ones that I target on a daily basis, and I give you the complete list with all the symbols. I want to make sure that you have everything to get you started right away, and having access to the right stocks and ETFs is very, very crucial, as you know. I'm also going to teach you how to combine different types of moving averages to create price channels that identify high probability opportunities with low risk per trade. And when I show you how to identify price gaps and inside day patterns, you will have all the tools to help you target explosive momentum price moves in just a few short days. Now keep in mind, trade entry is only half the battle. Once you're in the trade, you need to manage the position the right way. And I'm going to show you how to combine price channels with pivots so that you know whether to adjust your stop level, all without second guessing yourself, okay? You will find that my proven position management tools will keep you in profitable trades longer and get you out of losing trades quickly with less risk per trade. That's important, right? You want to risk as little as possible on each trade. So I'm going to show you that once you enter a trade, your risk is minimized very quickly, okay? Now, essentially, the swing trading stocks and options for weekly income is a complete package designed to summarize close to 30 years of my professional trading experience in a simple to understand 3.5 hour step-by-step video training, okay? When you sign up for the Swing Trading Stocks and ETF for Weekly Income course, you get your own personal members portal that you can access 24/7. You're also going to get a PDF of the entire presentation so that you can review the material at your leisure at any time you like, either online or off. So you can print this out if you like, okay? I want you to succeed and become profitable, of course, right? So I'm always here. So I'm going to offer you complete lifetime email support. And quite frankly, if you have a question, I want you to pick up the phone and give me a call as well. I love talking to my students, as a lot of you already know. So I'm very accessible. I'm here all day. I'm trading. And so my goal is to help you. So what I've also done is I recorded about 2 hours of questions and answers from students in the past. So I've got that recorded in the members area as well. So you're going to get all of that. Okay. So again, I'll be with you every step of the way if you need any help. Okay. Again, either my staff or myself, preferably me, right? So again, I'll respond with all your questions. And again, I'll give you my personal cell number. You can call me at any time. This is what I do full time. I'm trading and I want to help you succeed. I love this business, and I quite honestly, I can't imagine doing anything else, okay? So again, I'm here is for as long as you need me. All right, I don't see any more questions right now, but please, if you have more, be sure to type those in the box below and I'll either answer them or have my assistant Scott type back a response for you, okay? All right, okay, I see a question from Philip. All right, good to see you, Philip. I'm glad you made it today. Okay, his question is, what are a couple advantages to pullback trading? Great question. Okay, I don't know if I answered that earlier today, but let me go through it again. And again, as most of you already know, trading pullbacks truly gives an unfair advantage over other traders in 3 big ways. And now, if any of you have been following me for any length of time, you know that probably 95% of all my trades, right, all my strategies rely on the pullback, okay? So let me give you reason number 1. Remember, pullback trading offers high probability entry opportunities with much lower risk per trade. Therefore, that really does help you grow your account much quicker, okay? I would say the second would be that the profit for every dollar at risk over time tends to be higher when trading pullbacks in comparison to other strategies like breakouts. I would say that the third advantage that pullbacks offer, okay, again, pullbacks or retracements are ideal for option traders. I know a lot of you are option traders, okay? Because volatility, like I said earlier on in the presentation, volatility levels decline during pullbacks. And that's what you want. You want to see volatility declining when you're buying an option, okay? And what this does is it lowers the premium you pay for the option, just like I discussed about 25 minutes ago, all right? Let's see. It looks like I've got a question from Carla. Carla, good question, and glad to see you here today. Okay, everybody. She's asking me how it is to have immediate access. Okay. Oh, wait. What is it? Okay, I'm reading it wrong. Okay. Oh my God, I forgot to even include. Okay, she's asking me how much is it to have immediate access into the swing trading stocks and ETFs for a weekly income course. My God, I can't believe I forgot to even mention that, and I've gone this far. Okay, well, okay, Carla, everybody else here that's with me, let me ask you this question, okay? And this is really important. If all you did was take the swing trading stocks and ETFs for weekly income course and discovered a new, more predictable and profitable way to trade the markets, or if all you did was have direct access to me for as long as you want, right? To stay by your side, to answer your questions. Or if all you did was learn a new way to earn a consistent weekly and monthly income using these strategies, okay? You have to ask yourself and be honest. What would these benefits be worth to you as a trader? Okay? So do me a favor and just type in what this would be worth to you. I want to see kind of what everyone's thinking here in the room, then I'll go on, okay? So again, I'll give it about 10 or 15 seconds. What would that be worth to you to have me available pretty much all the time, answering all your questions, clarifying things with you, in the whole 9 yards? And again, what I'm also going to include in this package is I've got 2 to 3 hours of questions and answers that I did back when I first offered this program. And I believe it was 2014. It's been almost 3 years since I offered this last, okay? And I had 2 or 3 Q&A sessions, and I answered all the questions, went through everything, and that's also recorded, and that will be in this members area where the course is hosted, okay? So, all right, lots of people answering, boy. Okay, a wide range of answers, okay? I've got, let's see, Scott, even Carla, okay, Pete, Jack, Scott, okay, I'm seeing a bunch of $500. I see one, okay, 725, interesting number, okay. Got a couple entering a little over, okay, thousands, okay. Okay, a few of you, Bill, Terry, okay, priceless. Interesting, good answers. Thanks for contributing here. And again, I agree with all of you. I mean, really, it's hard to put a price tag on something like this. It really is. Again, if you just learn one nugget of information that helps turn your trading around or gives you a new tool, a new strategy for the toolbox to help you make money, I mean, I don't know how you really can put a price tag on something like that, because you can use it for the rest of your trading career, okay? All right. So again, the last time I offered this program was back in, I believe it was April or May of 2014. And I offered it then for $497. But what I'm going to do for you today, again, a very limited time, I'm going to slash the price. Okay, I'm going to slash $200. I'm going to take $200 off the $497. So it's only going to take $297 for you to have immediate access into the course materials, okay? So again, just go to the link at the bottom of this page to learn more, or to simply enroll, okay? But hurry, I'm only going to allow 30 traders like you to enroll, okay? Just 30. Again, I don't open up this program often, and I try to limit the participation since I can only handle so many people at a time, right? So again, I'm only offering 30 people in so I can devote my time to you and answer all your questions, okay? All right. I still have a few minutes left, and I noticed a few questions coming in that my assistant, Scott, hasn't yet been able to address. All right, thanks, Scott. He's been answering questions like crazy here. So again, Scott, I want to thank you. All right, so let me take a few moments to answer them for you. I've got a couple here. Let me read. And again, if you have any type of question about anything that I've discussed today before I end this class, please be sure to type them in the box below, okay? All right, I'll take it. Okay, Corey, he asks, what size account do I need to trade the strategies that I'm going to teach? Good question, Corey. If you remember back, I answered that for you about 30 minutes ago. Again, you can trade a real small account, as little as $500 to $1,000, and still be able to trade the strategies that I'm going to teach you. Because remember, everything that I'm going to teach you, you can trade with options. So you don't need a whole lot of money, okay? All right, next, Patricia wants to know, okay, is there any special software that you need to have in order to use the strategies? Again, Patricia, remember I answered that earlier, probably about 12 minutes ago. No, I mean, you don't need any special package. Any software package is going to work just fine with what I teach. You see, that's one of the great things about using the strategies that I'm going to teach you. You can actually use many free services if you don't have, TradeStation, let's say, or Thinkorswim or NinjaTrader. Again, there's many free sites online that'll enable you to, to look at the charts the way I look at them using these strategies, okay? All right, now Jack asks, what markets work best with the strategies that you teach in this program? Okay, Jack. Again, like I said earlier, I mean, I personally trade stocks and ETFs and even futures with the same strategies that I'm going to teach you here, okay? And Pete, let me get to your question here too, okay? So I'll kill two birds with one stone. Yes, I also trade options with these strategies. Absolutely, unequivocally, yes. So his question, again, Pete's question was, do I trade? Absolutely. That's why I spoke about options in today's webinar. And I have an entire section, probably 15 to 25 minutes about options in the program, showing you exactly which options to buy and how to use them. All right? All right. I've got time for one more question before I let you go. We're just running a bit over time here. Okay, now a few people have now been asking if there's any type of guarantee. Okay, good question. I expect that. So let me answer that for you right now. Now look, I'll make it real simple. Okay, I like to think I'm a real fair guy, actually more than fair. So, real simple, if you're not real happy with a program for any reason at all you have to do is call me up on the phone or email me, and I'll be more than happy to refund your money. If you're not happy, if you get this program and it's not for you, I mean, why on earth would I want to keep your money if you're not happy? It makes no sense. Real simple, straightforward, and I believe very fair. So again, you really have everything in the world to gain by at least giving it a try. All right? All right. All right, Jack just pointed out. Yep, you're right. Yep, Trading Concepts does have an A+ rating at the BBB, all right, the Better Business Bureau. Yes, I've been a member since, I believe, 1996. So, yes, a perfect rating. All right. Again, thanks for mentioning that. I really do appreciate that. It's true. Okay. All right, everybody. We have definitely gone over. We're definitely a little over an hour, and I apologize. But, again, I really hope you got a lot from this presentation. Again, I want to thank you for taking your valuable time and joining me today. Again, I really do appreciate it. And again, to join me today inside of the Swing Trading Stocks and ETFs for Weekly Income program, where I believe there are only 12 some, really. Okay, so my assistant Scott here is typing me. I've only got 12 programs left. Boy, people are just, okay, you see the value. I appreciate that. So only 12 programs left. Again, simply go to the link at the bottom of this page and sign up, and I'll see you inside, okay? And who knows, I'll probably throw in a little bonus. I'll probably do a live Q&A with all of you about a week after this, and we'll get together, and I'll schedule that with you. So, again, only 30 of you, 12 are left. I hope to see you inside. And, again, thanks again for attending. Bye for now, everybody.